Today I'm going to give you four different videos from economists and equity strategists, different views of the market. One of them will make the case for the market is going up from here. A couple of them are going to make the case for the fact that we have a correction or a recession in front of us. So I want to show both sides of it. I'm trying to step away. I'll give you my opinion, but I want to step away so that, because the reality is we don't really know. And I'm trying to say, you may have one view or the other. This will support both sides, and then you can decide after that. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is August 29th, 2023. I'm going to play clips from different interviews. The first one is Joe Kernan at CNBC is interviewing Joe Lavorgna, chief economist at SMBC Nikko Securities America. And this is filmed on last Wednesday before the upcoming Fed meeting. And you'll notice that in the interview. He states several reasons, why he believes that we have a recession in front of us. He makes a strong case for it. Steepening yield curve, rising mortgage rates, which is going to put a damper, a headwind on home purchases and slow down the real estate market, and high credit card rates, which are in excess of 20% right now, and there's a lot of credit card debt. All of these are not signs of a growth economy, and because the market has gotten ahead of itself, and the economy has gotten ahead of itself, he believes that this is going to dampen it, which means a recession. When and how long and how deep, who knows? But I want to point out that remember that a recession, if we have one, a recession is not always correlated with the stock market or the bond market. It may be, it may not be. Usually it is for some portion of time and then ceases to be for some other portion of time. So I'm going to play this clip from Joe Kernan and Joe Lavorgna. Take a listen.
Street has got more optimistic that the U.S. can dodge a recession, but the Fed and its plans remain wild cards for many investors. We're expecting a clearer picture, maybe, when Chairman Jay Powell talks out in Jackson Hole. That's coming up on Friday. CNBC is going to have complete coverage of the annual gathering tomorrow on Friday. Leaseman is already out there for more. Now let's bring in Joe Lavorgna, chief economist with SMBC Nikko Securities America. I said earlier, you never get a recession when everyone's expecting one, and then you do get one when people aren't expecting one. So once we took it off the table, maybe that allows one to happen. You think that's true?
Yes, we could add it back, Joe, because recessions tend to be nonlinear events, which means there tends to be a shock, some news event, and then we have it. So, for example, in the last deep recession, 08, 09, people as myself were thinking recession was going to come sometime in 07. But that was, getting ready for it in 06. We were going through 08. The economy grew almost 2.5% in the second quarter of 08. Had Lehman not failed, that may have been even a more mild recession, if a recession even would have occurred, compared to, say, 2001. So these things can take a while. The problem I have right now, again, is the yield curve is still very inverted.
Not as much, though.
Not as much, but that's what typically happens when the recession comes, is that the curve then starts to steepen. Okay. But also what's happening now is as those mortgage rates have risen dramatically, way above 7%, you've got high credit card rates, you've got high auto rates, you've got tightening lending standards. All of the inertia, all the momentum is all pointing to the downside. So yes, recession to me is still going to come. And the lags are such that when you look at the yield curve, you look at the index leading indicators, we are still within the range of what's very plausible for one coming. But again, the date is always difficult to pin down.
Now I want to play the other side. So here, Scott Wapner, CNBC, is interviewing Gabriela Santos, chief market strategist for JP Morgan. She has an optimistic view of the market, and she's making the case for the fact that the market is going to go up from here. So take a listen to this.
Nice to see you.
So I look at your notes, and you say this is not necessarily the start of something worse once we hit the fall.
I think we've come a long way in a year and a half in terms of appreciating that the bear market is likely behind us, as we believe, and that we're back to seeing a normal period of volatility in equity markets from time to time. So a 5% pullback once a quarter, a 10% pullback once a year within a bull market. And that's where we think we are. Since late July, we think this is some good old-fashioned profit taking. You can really see that by the underperformance of those companies and sectors that had led before, whether it's large cap tech, semiconductors, home builders, or more recently even banks. So ultimately, how far this goes, we'll have to see. It's seasonally a weak period, and it'll very much depend on what happens with earnings and CPI in the weeks ahead. But ultimately, we still have a constructive view of stocks from here.
Okay, correct me if I'm wrong. You sound more positive on the market than you have been since we've been having these conversations.
Yes. And that has really changed since the end of May, because we, like a lot of people, had come into this year expecting a hard landing, or it was always a conversation about a mild recession, but there was an expectation of a recession taking hold mid-year, combined with margin pressure on the earnings side. And since then, we've had substantially better data on the macro front, showing a normalization of the labor market, but not a collapse. So that can still support positive consumption at the same time that we've had better data on the inflation front, especially June and July, super core increasing only 0.2%. We've also had better earnings data. If you exclude energy and materials, earnings actually grew in the second quarter. So we have now come around to this view of a soft landing as the base case of the earnings recession being behind us, and for it making more sense to take on more risk on the equity side especially.
Next, I want to play a clip from Carl Quintanilla is interviewing Art Cashin. Now, if you watch the financial news or have for a long time, you know that Art Cashin from UBS, was head of floor operations. He's now retired, but he was on the floor of the New York Stock Exchange for about 60 years. He is full of wisdom. He has looked at everything from the standpoint of what's going on here, what can I learn from this? So when they interview him, he's got, in my opinion, incredible knowledge and incredible wisdom based on about 60 years on the floor of the exchange. He made this, he and Quintanilla commented that they resonated with Chairman Powell's comments. This is following the Jackson Hole conference for the Federal Reserve, that he said that Powell made this statement that we are navigating by the stars under cloudy skies. Think about it. In other words, we don't have many indicators. I think there are indicators, and they are pointing in opposite directions. The economy is strong. It can support more rate increases. Inflation's going up. It needs to be brought down. Or where the economy is weaker, it cannot support that, and that we are on our way toward a 2% level of inflation. Whatever your view, there's data to support both sides. And so I think it's appropriate. I won't say I'm a fan of Chairman Powell. That probably is going too far. But I'm less critical of him than I have been of his predecessors. So he has been dealt a horrible hand, and in my opinion, he's doing the best he can. And I think that is a correct statement. It's not like we don't know what we're doing. It's just we don't have very good guidance. It's pretty fuzzy. And so they keep looking at the data, and then when they come up to the next meeting, they make a decision. Of course, this meeting, they made the decision not to raise or lower rates. But if rates go higher, then this is not good for stocks and bonds. They will apply more rate increases. And no one really knows. But Art Cashin ends his comment by saying the key to the direction of the market right now is the yield on the 10-year Treasury. And I think that's insightful and correct. Take a listen to Quintanilla and Art Cashin.
On the Newsline this morning, Art Cashin joining us with UBS. Art, good to have you. I think the line this morning is navigating under the stars, under cloudy skies. Nice touch there by the Fed chair.
I came across with the same line, Carl. It was absolutely perfect. You know, he didn't say his compass was broke, but he did say it's a tough time navigating, and he didn't want anybody to pick up too strongly. So we are left looking at that yield on the 10-year, which has become all important. We get down below 4.22, and we might get some bids coming into the stock market. We get back up around the 4.35 area. That'll bring out some caution. So it's all about what that yield will be and how we react to what the Fair Chair said. But you're right. He basically said, "I'm not exactly sure where we are, but I'm trying to navigate in a very cloudy night."
You know, Art, I believe the last time you were on, you were talking about the S&P's levels and where we were testing roughly between 4,440 and 4,535. Right now, we're sitting at about 4,380. Lost some of the earlier gains. What do you make of that in the reaction to Powell?
Well, again, the market is being cautious. It's taking its own pulse and its own temperature. On the S&P, I would watch to see if they get resistance on any rally attempt to get above that 4,400 level. There does seem to be a little bit of mild resistance there. But I would say if I have only one instrument to look at, it's going to be the yield on the 10-year, and I think that will dictate exactly where things are going.
And then finally, I'm going to play a piece from an interview with Bloomberg's David Westin and Chief RBC Chief U.S. Equity Strategist Lori Calvasina, and she, I think, says it very correctly. She said, we're at a point where we are starting to see and are likely to continue to see money come out of U.S. equities for the next 4 months. And he's trying to pin her down as to where we're going to go for the rest of the year. Maybe it's beyond 4 months, but that's the period she's addressing. And she gives the best case scenario, the base case, and the worst case from where they see it today to the end of the year. And she gives reasons for that. I agree with her analysis, and it is consistent also with Morgan Stanley's Mike Wilson. Take a listen to this.
We have a rare opportunity here tonight because we have not one but two Bloomberg gals present in you and Scott. And he just mentioned he's at 4,600 year end this year. You're at 4,250, right? And the 4,300 is the median. Is there much difference between that 4,600 and the 4,250? And what might push you to the lower number?
So we're basically at the median right now, and that's also basically the average of 6 different models that we run. And our most bullish model gets us up to 4,800 on the S&P. That's looking at where we think valuations could be and our earnings forecast. But the real drag on our model, I would say, is actually our cross-asset indicators, which look at stocks relative to bonds. Now, that was a reason to be bearish at the beginning of the year, but we did see some improvement on those models in the second quarter. What we've seen recently with this move up in bond yields is that those models are rapidly getting more or less favorable favorable for equities, more of a pressure point, and we are actually starting to see money flows come out of the U.S. equity market as well.
That was just my question, because you've always, Lori, been telling us, we really need to be in equities. People are underrating equities. But are you starting to see flows? It is substantial right now as the bonds become more attractive with those yields.
So what's interesting is that to start the year, everyone said, okay, bonds are more attractive than equities, and we did see money flow go into bonds. And then we actually saw in the second quarter money come back into U.S. equities as it was being pulled out of Europe. So there was an international dynamic that helped the U.S. equity market. But what we are seeing now is that we're getting to a point in the year where these flow trends tend to fade a bit. You're seeing those European equity flows stabilize, and that money is actually coming specifically out of the growth part of the market, and that's pulling the overall U.S. equity flows down.
So I'm not going to give you today charts of economic data, which I do sometimes. I just thought that the interviews there gave us a broad perspective on the market. I happen to agree with Lori Calvasina. I thought she did said it correctly and gave a good analysis, but I thought there were good points to take away from the others as well. So the bulls are saying, we're tightening, Jay. It's not good for the bull side of the market. Thank you for watching. If you have questions or comments, leave them in the comment section below.